Hey, it's time now for today's strategy session. The Santa Claus rally could fail to materialize this year, but don't panic yet. We haven't had a Santa rally in the past 2 years. The S&P still rose more than 20% for both. Joining us to break down the technical indicators and what they're telling us for the year ahead, we've got Adam Turnquist, LPL Financial's Chief Technical Strategist. Adam, great to have you on. So we may not get Santa this year for the markets. What does that tell us about performance to come for 2025?
Hey, good morning. Happy New Year, and glad to be here. We're getting close to that end of the Santa Claus rally period. For those not familiar with that, it's the last 5 trading days of the year plus the first 2 trading days of the year. So that wraps up on Friday after market close. Of course, the level we're watching on the S&P, 59.74. That would trigger a positive Santa Claus rally. And why is that important? It tends to produce positive January returns and a positive year for the following year. On average, when you get a positive Santa Claus rally, the S&P 500 up over 10% higher nearly 3/4 of the time. When Santa brings that lump of coal and you get a negative Santa Claus rally, average annual returns over the following year only at 5%. So pretty big contrast between when Santa shows up and he doesn't show up. So we'll see how that plays out by Friday.
So Adam, what should investors then expect for the month of January? How much volatility should they be prepped for? Could we potentially see some sort of catch-up trade?
I think it's going to be a return to normal volatility. If you look at 2024, it was very low volatility. We only had an 8.5% drawdown maximum on the S&P. Historically, that is very low when you look at the average drawdown for any year, about 13 to 14%. So a lot of up days, a lot of record highs, a very low VIX. We think volatility will return. Maybe it happens in January. That tends to be a positive year for stocks. Average return for January up, I think, 1.4% or around that level. So we'll see if this momentum, longer term momentum, continues. But we expect more of a average year for stocks. The 20+% returns is not in our forecast. We just went out with our outlook earlier this month, called it pragmatic optimism, and we think that really sets the tone for 2025.
How do you maintain the ability to have pragmatic optimism when you have such a bullish street surrounding you and so many other bullish price targets, given some of the potential earnings estimates to come for some of these big tech names that have really driven so much of the gains so far?
Good question. And I think when you look at our outlook for next year, we're talking mid to high single-digit type returns for the S&P 500. And some of that sentiment that you referenced, everyone seems to be all in on equity markets. We just had the largest quarterly increase in sell-side strategist price targets for the S&P ever. At least data set goes back to late 1999 or the late 90s. So everyone seems to be forecasting a pretty bullish outlook. And I think for good reason. When you look at the economy, has been relatively resilient, holding up better than most people expected, inflation moving in the right direction, and then look at corporate America delivering what could be double-digit earnings growth for the fourth quarter, near record high profit margins. But how much of that good news is priced into this rally that we're seeing, especially when you look at the political environment as well? A lot of rosy expectations for tax reform and more of a pro-growth agenda. We'll see how that gets delivered and when President-elect Trump takes office in January.